Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And we're going to talk about the latest energy and mineral rights news for November of 2023. Justin, it's starting to feel that time of year here in Colorado. We got several inches of snow over the weekend, but like we say almost every month, it's hard to believe that we're already in the month of November here.
Amen. Yeah, it's right before Halloween. And yeah, I think the whole time I've lived here, it's always snowed just right before Halloween. And it didn't fail this year.
That's right. And it was always Murphy's Law when I was growing up here in Colorado. You're super excited to put on your costume, and then it snows on Halloween, and you have to wear your parka over your costume, and you're all upset because you didn't get to show it off. And I think it's going to be okay for the most part for the kids that are trick-or-treating tomorrow when we're recording this. It's Monday, October 30th, like Justin indicated. So this time of year, snow is definitely not unusual, but I'm not quite ready for the cold weather. It's been so warm here that I've been enjoying this Indian summer that we've been having.
You said it, Matt. I couldn't agree more. So, Matt, here are our first story. So we're starting to see some acquisitions happening again, which is interesting. They had slowed down for a while. And this first news story is why Exxon and Chevron are doubling down on fossil fuel energy with big acquisitions. And the story goes on to say on Monday, Chevron announced it's acquiring oil and gas company Hess for $53 billion in stock. Less than 2 weeks prior, ExxonMobil announced it was acquiring an oil company, Pioneer Natural Resources, for $59.5 billion in stock. And Matt, it talks about how this is because these large companies and non-government companies, they don't see an end to the oil demand in the near future. That's from Larry Goldstein here, the former president of the Petroleum Industry Research Foundation. So, Matt, interesting to see that Exxon and Chevron are kind of looking at that and not only looking in the United States, but looking internationally as well.
Yeah, that's an excellent point. And I think it just goes to show how, at the end of the day, economics drives business decisions. And if it's more economic to invest $1 in a oil and gas project versus a renewable project, they're going to do that. And I think we're seeing in the United States in particular, these US-based companies are really focusing in on additional acquisitions of companies that have large oil and gas reserves that can be turned on relatively quickly. And reserves refers to basically the oil and gas under the ground that is known to be there that just needs to be drilled, right? So they maybe have drilled other wells nearby. They have other acreage that is still available to drill additional wells. Then it's just a matter of getting the capital and going and doing the work. And we're seeing this play out with Chevron and ExxonMobil, where they're looking at how do we grow our reserves base? In other words, grow the portfolio of additional locations that they can go drill quickly if needed, because it goes to show they're realizing the reality of the fact is that we're consuming a record amount of oil and gas globally. You know, our actual production here in the US is hitting all-time highs now again, finally for the first time since before the pandemic. And for the foreseeable future, that's not going to change in terms of our oil demand falling off a cliff. Like if you read some of the global headlines around the energy transition and, you know, we're all going to die if we don't stop using oil and gas by 2030, the reality is we need to have a plan to get there from here because we can't just shut off all the oil and gas production overnight. Tomorrow morning we wake up, none of the lights would turn on, our food would spoil because we wouldn't have refrigeration, all these things that require cheap and abundant and reliable energy. These companies realize, hey, I need to keep investing to replace the oil that I'm producing today because especially in these shale basins, if you're not continually drilling, the production is declining at a very fast pace. So even just to maintain the current levels of production, they need to reinvest into these shale basins. And so that's what we're seeing here. They call it short cycle shale reserves just because they can be drilled very quickly and production can start very quickly relative to, you know, if you're going to build a large offshore platform, it takes a decade and that kind of a thing. This is something that they can turn around in 6 months and start to bring in incremental production online. So I thought that was really interesting as well, Justin.
Absolutely, man. I thought it was interesting. The article mentions the International Energy Agency said that the global demand for coal, oil, and natural gas will hit an all-time high by 2030. So, kind of what you mentioned, Matt. We're hearing a lot of talk on the other side, but the road just isn't there yet. The infrastructure that is the coal, oil, and natural gas.
Yeah, exactly. And even you look at the international companies, I saw an article this past week that Shell was ratcheting back some of their low carbon fuels business, like the hydrogen side of things. Like they were looking at originally building out hydrogen fueling stations. They were realizing that really EVs are the way that we're going to decarbonize the transportation sector potentially, although that's a whole conversation in and of itself. But at least even those large international companies are re-looking at their original plans just because of the economics of some of these projects has changed. And Chevron, really interesting on this particular acquisition of Hess. Hess has oil concessions in Guyana, which is a country in South America, and it is low cost to develop that, and it's closer to home, closer to the U.S. And especially with all the things that are going on in the Middle East right now and in Europe, with Ukraine, getting it close to the U.S. in a relatively more geopolitically friendly area, there's a lot to be said for that. And I think that's interesting that it wasn't all just onshore U.S. Acquisitions. It actually Hess had a big asset in Guyana, which is one of the things that Chevron was looking to go after as well. So yeah, pretty interesting to see. I think that we're just beginning to see these large consolidation. I think this as oil prices stay high, as these large companies have really robust balance sheets, they have a lot of cash that they need to spend. A lot of times, the way they're going to grow their reserves, like we talked about, is going to be acquiring other companies. And so I expect to see continued acquisitions, especially into early next year. And I think even Exxon had indicated they're not done yet in acquiring additional companies, even after spending $60 billion on Pioneer. So pretty interesting to see that. From a mineral and royalty owner perspective, I think it's important to mention. So I have a client that has some interests that Pioneer operates, and they were asking, "Hey, what is this going to mean for our interests? Is this good, bad, indifferent?" And with ExxonMobil, the way I look at it, when you have a company like that acquiring Pioneer, I would expect that you're not going to see much change. Both of those are large public companies, have a lot access to capital is good, so I expect to see pretty similar pace of drilling, in that Pioneer acreage. I think where you would see a difference is if you had interests that are operated by a private company. So we'll have to wait and see what additional acquisitions occur, through the end of this year and into the beginning of next year. And if you see some smaller private companies that maybe are a little bit cash strapped, get bought by an Exxon or a Chevron, or you name whatever large oil and gas company, major oil and gas company that is publicly traded that maybe has a lower cost of capital, then it could mean that the pace of development increases. Things could get drilled sooner. So it really just depends. But yeah, I think if you have interest that where Hess is the operator or where Pioneer is the operator, I would expect sort of business as usual once those acquisitions close and Chevron takes over for Hess and ExxonMobil for Pioneer. I would expect things to be pretty similar. All good operators, do what they say they're going to do. And so I think, yeah, it's pretty much business as usual in that case.
And to that point, Matt, it was exactly the case for me when Occidental took over Anadarko. You didn't feel much change at all. It was made clear that it was happening, but that everything would just continue business as normal.
Yeah. And the only thing I would say is make sure you check your check stubs once those deals close and you start getting paid by the new operator. Make sure that your decimal interest is correct. Make sure that you don't see a big jump in post-production costs. Those types of things are always good to stay on top of if there's ever a change of operatorship. So
All right, Matt. Our next one here is kind of talking about the geopolitical world, the impact it's having on the price of oil. So the headline here is World Bank major escalation in the Israel-Hamas war could send oil soaring to $157 a barrel. And so it continues to say that the World Bank sees oil prices averaging 81 per barrel in 2024 if there isn't a major disruption due to the Israel-Hamas war. If the war were to escalate into a major regional conflict, the prices could climb as high as $157 a barrel. And then it goes on to say that there are other scenarios in which the escalation in the region isn't as drastic, and it has it trading from anywhere from $93 to $121 a barrel. So, Matt, this is a pretty wide range, but not surprising that the geopolitical stage is causing the price of oil to fluctuate some, not for a great reason, unfortunately.
Yeah, unfortunately, it's never good to see any sort of major conflict pop up and people suffering. And so, our hearts go out to those that are affected by this. But hopefully it ends up getting resolved soon. And, even if it means the price of oil goes down, I think that's what everybody wants to see. But I think it is important to think about, with the geopolitical environment that we're living in, that has a huge impact on the price of oil. It's these supply disruptions that can cause oil to go up. And that's what's being referred to by this World Bank article, is that in these different disruption scenarios, I think it's like, currently, if there's no disruption or minimal disruption, then prices should stay about where they're at. We didn't see much of a bump once that conflict erupted. Effects on global commodity prices, as this World Bank article mentions, has risen about 6%. So it's up a little bit, but certainly nowhere near what we saw with Russia's invasion of Ukraine in 2022. And so there we saw a huge bump in oil prices and a big disruption in natural gas in particular. With Israel, I think we're seeing some disruption to delivery of natural gas to Egypt as one example, where they were having some rolling blackouts. As we were recording this, I saw an article that mentioned that because Israel does produce a fair amount of oil and gas. If we do see a major disruption in that region in particular, then yeah, I think the sky's the limit with the price of oil, because like we mentioned earlier, we are consuming the record amount. Our production is trying to go up to meet that, but for now we're kind of on that razor's edge in terms of supply and demand. If a major disruption happens where a lot of that supply gets taken out of the market, then I think prices will go up quite a bit in response to that. Of course, what remains to be seen is what OPEC Plus would do. I think they had been perhaps holding back some of their production to try to keep prices high so that the Saudis would be breaking even and paying for all the princes and sheiks and all their private jets and all that kind of stuff, I guess. But if that ends up becoming a situation where it goes too high, then maybe they'll try to increase the supply quotas to try to bring prices back down. Don't know how that would affect what if I'm sure the World Bank has taken that into account, but at the end of the day, I wouldn't be surprised if we see price of oil touch $100 a barrel or higher if we do see a disruption in any sort of measurable amount of oil getting taken off the market.
You said it, Matt. All right. And so our last story here is getting into the bonding, which we've talked about quite a bit in Colorado. And oil and gas regulators boost KP Coffin's proposed 10 million well cleanup bond to 133 million. And Matt, it says that the regulators have shown that they're serious about making sure the oil and gas industry cleans up after itself. The Colorado Energy and Carbon Management Commission rejected a company's plan for financing its cleanup cost. And it goes on to say that the ECMC unanimously voted against the plan by KP Coffin Thursday after several hours of testimony stretching over 3 days. The company proposed putting down $10.3 million to ensure that it'll take care of all of its wells, and the members voted to require the company to pay roughly $133 million over 10 years. And Matt, they're saying that this is far more than the rest of the industry, but this is for about 1,000 wells.
Yeah, it was interesting to see the amounts because the article mentions that the industry itself has had to put up over 570 million for 38,000 wells, and that's as of September 26th. They had approved 151 financial assurance plans, so that's basically 151 other operators gone to the table with the ECMC, which is just the rebranding of the Colorado Oil and Gas Commission. That's the board that overlooks the oil and gas operations and operators in the state of Colorado. So the industry, like we mentioned last year in an episode, and we'll link to that in the show notes, but the financial assurance regulations have been totally revamped in Colorado to up the amounts that are required for companies to be put up to ensure that if they go out of business, that the state isn't caught footing the bill to reclaim those sites, to plug and abandon the wells, remove the equipment, reclaim the surface, all that stuff. And so they've been increasing those amounts, and that's part of this process is the implementation of those new financial assurance regulations. And so that's what this article is referring to. And for major operators or for operators with a large number of wells, they've looked at it on a case by case basis, just basically instead of having them put up, the required amount per well, coming to the table and negotiating basically what kind of funds need to be put up in order to ensure that they're going to be around. Again, the state isn't caught footing the entire bill for reclaiming those wells. Now, the interesting thing about this particular decision is that KP Kaufman is one of the most fined operators in the state of Colorado in terms of violations of different Colorado Oil and Gas Commission rules and things like that. So they have kind of a history of being in the news around compliance issues, et cetera. And so they claimed that the decision is where they feel like they've been treated differently than the other operators and more harshly in particular. And they should have been falling under the same amounts that other companies are faced with. If you look at that $570 million across all those 151 other operators for 38,000 wells, that boils down to, I think we calculated it like $13,000 per well that the companies are putting up. The KP Kaufman decision is like almost 10x that. So I kind of see where they're coming from in terms of, being treated differently. Although you mentioned a good point, Justin, before we hit record, is that, a lot of their wells are low producers. And so they are going to require closure sooner than later. So part of those financial assurance rules was that low producing older wells, they need to have a plan to go and plug and abandon those in a certain period of time. So I think that was a good point, Justin.
Yeah, absolutely, man. And it's, interesting to see if that is the reason, and, if there is a way that they're coming up with why it is so much more. But I'm sure from KP Kaufman's side, it's really putting a lot of pressure on their company coming up with that money. I'm sure that's a very difficult situation to be faced with on the business side.
Yeah, if you think that the most of these companies have that kind of cash lying around, it's probably not the case. So, there's a time period. They don't have to put all that money up right away. It sounded like they had to put 10% of that up initially, and then have, I think, a plan to finance the rest of it or whatever. So, but I think it's a good point, Justin, is that a lot of these small mom and pop operators, it's just not going to be feasible for them to operate in the state of Colorado just because of these additional burdens that are being placed on their balance sheet, because they have to then basically put all that cash up front or potentially finance it. But either way, they have to set that money aside, and they're not earning interest on it. They're not growing the business. That's just a liability, and they're trying to operate prudently, et cetera. So there's a lot of good companies out there that are doing the right thing, that just have a few wells that are low producing wells. Well, now all of a sudden they're having to put up a lot of money to cover the potential closure of those wells. I kind of struggle with this a little bit. On one hand, I think it's a good thing because, I don't want to see those companies go out of business and increase the orphan well burden on the state and on the landowners. But then on the other hand, you want those additional barrels, especially as a mineral royalty owner, to be produced. And even if they're low producing wells, if they're continuing to produce oil or gas and you have a good royalty on that, that's money in your pocket each month. And if that well has to get closed early because of these financial assurance rules, then those are barrels that are never going to get produced. They're basically locked under the ground forever. And so as a royalty owner, that hurts us. But on the other hand, we have the ability that those wells will get cleaned up, that, they're not going to get left behind and become an environmental liability. So tough situation, Justin.
You said it, man. And, it'll be really interesting to see if one of the large operators decides to come in and use this as an opportunity to purchase their assets, and are able to put up that money. And if that's the way it goes, or if they're able to finance themselves out of this, or how it ends up. If a KPK ends up filing bankruptcy, I don't know that that's going to help the state of Colorado a whole lot on getting those wells cleaned up, and who's going to pay for it and how that'll play out.
Yeah, that's a great point. And, aside from all of this, there is a reference in this article to several complaints against KP Kaufman. Yeah, earlier this year, there's been an ongoing ruling to resolve those complaints. They missed a deadline for KP Kaufman to comply with state rules or face it losing its license. They put that order on hold to remove their license until an appeal is decided and a trial is scheduled for 2024. So, amidst the increased bonding amount that KP Kaufman is being faced with, the other thing that's going on behind the scenes is now going to be a trial to figure out how to resolve these complaints and these compliance issues. And there is a chance that they get their license to operate gets revoked. And to your point, Justin, what happens then? If they haven't put up all the money on the bonding side and they go out of business, they go bankrupt, then the state basically is going to inherit those 1,000 orphan wells unless they can be sold to another operator that's going to come in. If the acreage is prospective for future oil and gas, nobody's going to come in just out of the kindness of their heart. They would do so if those wells are holding leases that are, in good areas that additional wells can be drilled, and they could maybe come in and buy that acreage for pennies on the dollar and drill those additional wells. And then as part of that development process, they'll plug and abandon the low producing wells. So interesting to see what happens here. A lot behind the scenes on this particular deal with KP Kaufman. And, I imagine they look at these on a risk-based way. Like some of those other operators could be that they operate a lot of wells, but they're also large horizontal wells that are going to produce for decades. And so the liability there is a lot less to the state versus, low producing well that's on the verge of getting plugged and abandoned in the next couple of years. So that probably had a lot to do with the decision on how much KP Kaufman had to foot the bill. But I think the moral of the story here is, regardless if you have interest in Colorado or not, is these types of increased regulation are going to be put in place, I think, in a lot of other states as they look at the orphan well issue and how do we prevent that from growing? How do we get a handle on this? And especially Texas, Justin, when you think about one of the states that has the largest number of orphan wells, the Permian Basin has got to be on the top of that list. And so I think Texas, I would be surprised if they don't do something similar in terms of increasing the bonding amounts and all that kind of stuff.
Yeah, absolutely, Matt. It's just required. The amounts that it costs to plug and abandon those wells and do remediation is huge compared to what operators used to have to put up for that.
Yeah, that's a great point.
All right, so rig count, Matt. If nothing else, it is kind of leveling out. We're not losing as many. Looks like there was a rig down in Louisiana, New Mexico, added one in Pennsylvania, added 3 in Texas, and then down 1 in West Virginia. So not a huge increase, but it's staying pretty flat.
Yeah, it's good to see it staying pretty flat. We're ending the week of October 27th at 600 land rigs as compared to 599 a week before. The total in the US is 625 against 624 a week ago. So, yeah, picked up one additional land rig. We were looking back at where we were in September, and we're pretty close to the same number. I think we were down a handful from that, but certainly the numbers haven't been falling as much week over week as we saw a month or so ago. So I think we're probably in a situation where we've sort of plateaued out, and this is the number from now to the end of the year, the exit rate, as it were. And I think that's partially because, like we talked about in the past, these companies are kind of getting up to their capital budgets for the year, looking at maybe they've been drilling faster than originally planned. They're running out of capital. So they're laying down a rig through the end of the year, and then they'll pick it back up in January and then continue drilling. And certainly if the price of oil plays out like this World Bank report talks about, I wouldn't be surprised to see the rig count going back up again if, again, we're above $100 a barrel, because a lot of those wells that maybe weren't economic to drill at 80 are economic to drill at 100. And if they're generating that additional cash, they want to reinvest it, that kind of a thing. So good to see stabilization on the rig count.
Yep, absolutely, man. Kind of took some of the articles we're talking about the importance of it being quick to be able to drill and proven reserves. Most of these additions, one was in the Permian Basin and then one in Eagle Ford here. So it kind of makes sense that they're going for whatever they know is proven and can get the resources out of. Matt, what's your thought for what would kind of cause the operators to start going for the assets that maybe were less proven again?
Yeah, I think, certainly, especially these other basins that have seen big drops this year that are primarily gas focused. I think if we see the predictions on the LNG export capacity, which is going to start coming online later next year, I think we'll start to see that boost some of the natural gas prices as well. If it's a really cold winter and we see higher natural gas prices into the early part of next year, then maybe some rigs will go back to those other basins like the Marcellus, like the Haynesville, like Oklahoma, the Woodford, things like that, where there's a lot of gas. So I think that's a big question. But yeah, I mean, I think, again, high oil prices, a lot of these other basins. So like you earlier, the Permian is probably the best economics of any basin, certainly in the US. And so that's why you see so much activity going on there compared to some of these others. The Eagle Ford is a very well-known play, pretty mature at this point. So they're going in, they know what they're going to get. Good economics there. DJ Basin in Colorado, same thing. I think if you are going to see step outs into some of these other areas, it's where you need to have sustained high prices. So I would think if we're having this conversation next year and the price of oil had averaged over $100 a barrel through 2024, then for sure we'll see an increase in some of these other areas. But yeah, I think you need sustained high oil prices for that to happen.
Yep, that seems to make sense. All right, Matt. Well, that takes care of it for this news episode.
All right. Well, yeah, thanks again for listening. If you would like to check out the links to the articles mentioned in this episode, you can do so in the show notes at mineralrightspodcast.com. And if you come across an article you'd like us to cover, you can send it to feedback@mineralrightspodcast.com. So thanks again, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.